California real estate has been marketed to an entire generation as the one asset that never really cracks. The pitch was always clean and confident. Too many people, not enough buildable land, and an economy powered by technology, entertainment, defense, and venture capital that produces high earners at a density the rest of the country can't match. Buy in California, hold long enough, and the math will rescue you. Time becomes your partner. The state becomes your safety net. That story worked for a long time, long enough to become dogma, long enough that pushing it back sounded like you didn't get it. But markets don't run on slogans forever. Markets run on affordability, supply, incomes, confidence, and, most critically in this cycle, the cost of money. Right now, those fundamentals are not cooperating with the California narrative. Mortgage rates didn't just rise, they rewrote the rules. A home that penciled at 3% becomes a totally different proposition at 7. The payment doesn't creep up, it detonates. The same property, same price now demands a share of household income that violates every sensible rule of risk management. And yet, in many parts of the state, prices haven't adjusted nearly enough to reflect that new reality. That isn't stability. That's denial stretched over time. What you're seeing isn't chaos. It's a slow motion repricing of a decade of cheap capital. For years, low rates acted like a lever. They pulled demand forward, expanded borrowing power, and allowed prices to rise faster than wages. When that lever snapped back, it didn't politely return to neutral. It changed the entire equilibrium. This repricing isn't happening evenly. California is not one market. It's a collection of microeconomies with different job bases, different buyer pools, different levels of speculation, and different exposure to insurance, regulation, and migration trends. Some areas are vulnerable because they were bid up by remote work assumptions that are now being reversed. Others leaned on a single industry that's weakening. Others still were inflated by outside money. Bay Area and coastal capital chasing inland affordability. Money that disappears the moment uncertainty rises. So this is a ranking of the 10 California markets carrying the most near-term risk. Not based on vibes, not based on headlines, based on the signals that historically show up before meaningful corrections. Swelling inventory, longer time on market, rising price reductions, widening gaps between list and sale prices, and demand drivers that are deteriorating instead of strengthening. This is the countdown. 10 to 1. And the pattern matters more than any one number because the pattern tells you what phase of the cycle you're in. And whether you're early, late, or about to be the liquidity for someone else's exit. Number 10, Riverside. Riverside spent years as California's pressure valve. When Los Angeles and Orange County turned into markets for the already well-capitalized, Riverside became the still possible option. A yard, a driveway, a detached home, and a payment that, at least during the low-rate era, didn't require a second income and a prayer. Then remote work poured gasoline on it. If you didn't have to commute 5 days a week, distance lost some of its sting. Riverside didn't just make sense, it looked like a smart arbitrage. Demand surged, listings vanished, and prices climbed fast enough to create the illusion of a permanently upgraded market. But the remote work premium is fading. Employers are pulling people back to offices, and the distance penalty is returning at exactly the wrong moment. Many peak buyers weren't seasoned investors. They were first-time homeowners and young families stretching to secure a foothold. High leverage plus lifestyle assumptions is a fragile combination. When the assumption breaks, the balance sheet is exposed. Inventory has been building. Days on market have expanded. Price reductions have become common instead of rare. And that last point matters. Price reductions aren't just a statistic, they're a psychological shift. They tell you sellers are no longer setting the market, buyers are. The rental math here deserves skepticism too. Cap rates compressed during the run-up, and carrying costs are now higher. If your entire plan relies on appreciation to cover thin cash flow, you're not investing, you're hoping. Riverside isn't doomed. It will remain a meaningful part of Southern California housing, but timing is everything. And right now, the entry point is doing you no favors. Number 9, Stockton. Stockton's history isn't ancient, it's instructive. This is a market that lived through the foreclosure crisis, endured municipal bankruptcy, and rebuilt slowly. The pandemic era finally pushed it into the spotlight again, largely because Central Valley affordability became irresistible to buyers and investors priced out of the coast. For a while, it looked like Stockton had found its next chapter. Prices rose, activity returned, investor interest increased, but the question has always been, what is Stockton's demand actually anchored to? A large portion of the demand surge was imported. Bay Area money moved outward, chasing space and price relief. That works when Bay Area employment is expanding and high earners feel secure. It weakens when tech hiring slows, layoffs spread, and equity compensation isn't funding down payments like it used to. Stockton's local economy has never been strong enough to justify peak valuations on its own. When a market depends heavily on outside buyers to hold prices up, it becomes highly sensitive to shocks occurring somewhere else. Days on market are longer, supply is higher. The direction isn't mysterious. The only debate is how far and how long. If you're an investor looking for a distressed cycle that creates opportunity, you may get it. But trying to buy while the floor is still sinking isn't contrarian, it's premature. Number 8, Modesto. Modesto shares the Central Valley DNA, limited high wage job density, heavy reliance on agriculture and service work, and a history of being the alternative when coastal markets become unreachable. What elevates Modesto's risk is the financing structure that helped push the market up. When a large share of buyers enter using low down payment loans, the equity cushion is thin. Thin equity doesn't just increase personal risk, it changes market behavior during downturns. Here's why. In a declining market, homeowners with minimal equity lose mobility first. They can't sell and move without bringing cash to the table. If job loss, family pressure, or rate resets force the issue, distress turns into inventory. Inventory turns into downward price pressure. And once the market starts pricing that pressure in, it can move in waves, not inches. Markets like Modesto often don't gently correct. They stall, then slide, then suddenly reprice when sellers capitulate. A key skill here is understanding the difference between cheaper and undervalued. A property can be down from its peak and still be overpriced relative to local incomes and job growth. The right approach is simple. Avoid new positions until inventory stabilizes and price reductions stop accelerating. Until then, you're stepping onto a moving walkway going the wrong direction. Number 7, Bakersfield. Bakersfield has a single industry exposure that can't be ignored. Energy. Oil has long been the engine behind a certain class of buyers. Well-paid workers whose incomes look durable until the commodity cycle turns or policy pressure tightens. California's regulatory trajectory isn't friendly to oil. That's not a temporary headwind. It's a long-term structural problem for any market tied to the industry's health. Bakersfield also experienced a meaningful run-up during the broader relocation boom. It benefited from affordability narratives and from buyers seeking space. But a market can't live on narrative when the underlying job base faces secular decline. Inventory has risen. Price cuts are widespread. The buyer pool thins dramatically when rates rise because affordability was the whole pitch to begin with. There's nothing surprising here, just a cycle playing out as expected. For investors, the yield rarely justifies the combined risk of industry pressure, market volatility, and tightening buyer qualification. This is a market to watch, not one to chase. Number 6, Fresno. Fresno is more complex, and that's exactly why it lands here. Unlike some neighboring markets, Fresno has more diversification: healthcare, education, regional commerce. It's not a one-note economy, and that gives it a sturdier floor. But a sturdier floor doesn't mean the ceiling wasn't overpriced. Fresno looked like the responsible Central Valley bet during the frenzy, and relative to others, it probably was. Relative safety, however, can still lose money in an environment where the cost of capital has changed. When months of supply moves into buyer market territory, it signals a shift in leverage. Buyers start asking for concessions. Sellers start negotiating instead of dictating. That's how price discovery returns. There's also an under-discussed factor. Agriculture isn't just a backdrop here. It's a financial bloodstream. Water policy, rising costs, commodity volatility, and export dynamics matter. When agriculture tightens, the effect ripples through Fresno with a lag, meaning the housing data can look fine until it suddenly isn't. Fresno can be a long horizon market for patient capital. It is not a market to buy, today expecting quick appreciation. If you enter now, understand you're stepping into a repricing cycle that may still have chapters left. Number 5. Sacramento. Sacramento might be the market where perception is most out of sync with reality. It has government employment, a credible regional economy, and a lifestyle advantage over the Bay Area that made it a prime destination during remote work migration. The boom story wasn't fake. It was rooted in real demand. The vulnerability is scale. Sacramento absorbed an amount of demand-driven appreciation that pushed valuations beyond what local incomes can naturally support. Bay Area buyers carrying Bay Area compensation bid up prices in a Sacramento income environment. That only works if those salaries stay attached to those zip codes. Return to office policies don't need to be universal to change behavior. They just need to be common enough to reduce the number of buyers willing to bet their future on long commutes or career risk. Sacramento has a floor because of government employment, but it doesn't have a ceiling-free runway. And that ceiling is where the pressure is building. More listings, slower absorption, fewer bidding wars, and increasing price realism. Pay special attention to attached housing, condos, and similar product. That segment tends to reveal weakness earlier because it attracts more investor and speculative activity during upswings and unwinds faster during downshifts. When condos soften, single family often follows with a delay. Sacramento will function. It's not collapsing. But the previous cycle's appreciation narrative is fading, and a new negotiation-driven market is replacing it. Number 4, Inland Empire, San Bernardino/Ontario corridor. The Inland Empire became one of the nation's most important logistics hubs. Warehousing and distribution boomed as e-commerce expanded. Industrial demand surged, employment rose, and housing followed. The story made sense. What changed is that the logistics surge normalized. After the pandemic spike, growth slowed, vacancy rose, and expansion cooled. When the industrial engine downshifts, the housing market that rode behind it feels the drag. Residential indicators are reflecting the slowdown. Longer days on market, more reductions, and price per square foot pulling back in the most aggressively bid up pockets. Investors who bought rentals assuming 2021 rent growth would continue are discovering that assumptions don't pay mortgages. The distance penalty is also back. Commuting an hour plus to Los Angeles is expensive in time and cash. During the low rate era, the trade-off was worth it. At today's prices and rates, the value proposition is less clear. This market is also geographically uneven. Properties closest to industrial hubs are most exposed to logistics, cooling. Properties bought on a pure remote work thesis are most exposed to return to office. The safest assets are the ones not dependent on either storyline, and those are the hardest to find at attractive pricing. Number 3, San Diego. San Diego is the entry many people resist emotionally because it feels like the kind of place that should never be at risk. It has natural scarcity, strong climate, defense and military adjacent employment, research universities, and a global brand. All of that can be true, and affordability can still break the market. When the median priced home requires a household income that lives in the upper tier of earners, the buyer pool becomes narrow. Not small, narrow. And when that pool shrinks faster than supply, price pressure appears even in desirable places. San Diego also has demand pillars that have softened at the margins. Defense contracting can slow in periods of budget uncertainty, and the biotech/life sciences ecosystem has seen layoffs and tightening conditions. These aren't apocalyptic forces. They're enough to reduce marginal demand in a market priced for perfection. Watch the luxury segment. High-end homes tend to show softness first. Longer time on market, fewer competing offers, bigger negotiation gaps. That premium tier often leads the broader market by months, sometimes by quarters. San Diego isn't about collapse. It's about recalibration. A market priced for flawless conditions is now operating in a world of higher borrowing costs and more selective buyers. Even modest percentage declines translate to large dollar corrections. If you're buying here, the discipline is psychological as much as financial. Wanting in after years of watching is not a strategy. Numbers are the strategy. Number 2, San Francisco Bay Area. The Bay Area is the most complicated case because two things can be true at the same time. It has one of the strongest long-run track records in the country, and it is experiencing real structural disruption right now. The tech correction that intensified after 2022 hasn't been a one-week headline cycle. It's been a business model reset. Cheap capital fueled growth at all costs. When rates normalized, that math stopped working. Hiring slowed. Then it reversed. And the real estate market that had priced in endless expansion is now working through a more restrained reality. Commercial office vacancy, especially in San Francisco, has become a visible symbol of the shift. That matters because cities are ecosystems. Office workers support restaurants, retail, services, and tax bases. When the core empties out, the ripple hits confidence, budgets, and lifestyle demand. Condos, particularly high-density product tied to young professional buyers, have shown significant weakness. Equity compensation isn't the tailwind it used to be. When RS Us are worth less, down payments shrink. That's not sentiment, that's mechanics. Single family in elite suburban corridors has held up better, but better doesn't mean safe. Inventory rises, days on market lengthen, and the urgency of multiple offers fades. That is how a market transitions. The Bay Area will offer extraordinary long-term opportunity at the right price. Its intellectual capital and network effects don't evaporate overnight. But the near-term path is not your friend if you're buying with the expectation of quick appreciation. Patience wins here, not as an attitude, but as a tactic. Number 1, Los Angeles. Los Angeles ranks number 1, not because it's the weakest economy in California, but because it combines extreme valuation, severe affordability strain, regulatory friction, and an event-driven insurance and financing problem into one concentrated risk profile. Start with affordability. The median home price requires a level of income that many households simply don't have, especially if you assume a conventional mortgage and a meaningful down payment. The market has been supported by a mix of equity-rich move-up buyers, foreign capital, entertainment wealth concentration, and investment activity. When multiple support beams wobble at once, the structure creaks. Entertainment disruption is not theoretical. The industry has been reshaped by changing streaming economics, consolidation, and cost-cutting. The strikes in 2023 also created downstream income disruptions that don't disappear instantly. This matters because entertainment isn't a side sector in Los Angeles. It's part of the city's financial identity. Then add the wild card, fire risk, and the insurance market. The major issue isn't merely higher premiums, it's availability. When insurance becomes difficult or prohibitively expensive, financing becomes difficult. When lenders can't secure acceptable insurance coverage, loans don't close. When loans don't close, the buyer pool contracts. When the buyer pool contracts, prices adjust. This insurance constraint isn't limited to obvious hillside zones anymore. It spreads through neighborhoods in ways that surprise people who thought they were insulated. And this is where Los Angeles becomes uniquely exposed. A market can survive high prices if financing is easy and confidence is high. When financing gets complicated and confidence gets fragile, expensive markets lose their margin for error. The luxury segment adds another layer. International buyer demand is sensitive to currency strength, geopolitical uncertainty, and capital movement. Domestic high net worth buyers become selective when markets feel unstable. The result is higher end inventory sitting longer, which ultimately bleeds into broader price psychology. Los Angeles will remain globally relevant, but relevance doesn't immunize a market from correction. Great cities correct too, especially when the cost to enter rises faster than the ability of residents to pay. For buyers who need to be here, the standard must be higher. Conservative leverage, verified insurance options, and a holding period that doesn't require appreciation to make the deal work. For investors, the bar is higher still. Yields, regulation, insurance, and price direction have to make sense on a spreadsheet that assumes flat to down outcomes, not a quick rebound. The bigger picture. These 10 markets don't share one single cause. They share one consequence. The cheap money era ended, and the assumptions built on it are being tested in real time. California priced the cheap money premium more aggressively than almost anywhere. That means when the premium comes out, the repricing is larger in absolute dollars. This isn't an argument that California is finished. Over decades, California real estate has been a powerful wealth engine. Scarcity, constrained building, global demand, and economic clusters are real forces. The question isn't whether California recovers. The question is, at what price level does the next durable upcycle begin? The discipline required now is to detach from narrative. Watching a market rise for 10 years and feeling late is not a reason to buy at the wrong moment. Seeing prices dip from the peak isn't automatically a signal either. Down from peak in an overvalued market can still be overvalued. A serious framework looks like this. Identify the true demand drivers. Verify they are intact. Confirm insurance is both available and affordable. Stress test the numbers under flat and declining scenarios. And commit only with a time horizon that doesn't depend on immediate appreciation. Patience isn't indecision. Patience is timing with standards. The people who look smart 5 years from now won't be the ones who found the courage at the first sign of a dip. They'll be the ones who waited for the moment the market actually offers favorable terms, realistic pricing, motivated sellers, and fundamentals that can support the purchase without relying on a rescue narrative. California is repricing. That process isn't done. And the investors and buyers who respect the cycle rather than fighting it will be the ones positioned to move when the true entry points appear. If this perspective helps, share it with someone making a decision in California right now. In a repricing cycle, the most expensive mistake isn't missing a deal. It's acting on an outdated story.